In this video, we're going to be discussing one of the 5 C's of credit. And the first one we're going to be discussing together is character and what you can do about it. If this is something of interest to you, stay tuned as we dive right in. So, what is character and what does it have to do with you? When it comes to character, there's not much a lender has to base off of since they don't know you. But what they are basing your character off of is your credit history and your payment behaviors. Now, in order to do that, you want to think about 2 words. You want to think about stability, and the second word is consistency. If you were lending someone hundreds of thousands of dollars, wouldn't you want to know that they're consistent? Wouldn't you want to know that they're stable, that they have income coming in and they have good payment habits? It's the same thing for lenders. It's very easy to think, well, why do they need all of this paperwork? Or why are they asking so many questions? But just imagine, think about all the money that they're lending out to people. They want to make sure that that money is coming back, that that money is safe and secure, right? So that's why they want to make sure that you're someone who's number 1, stable, and number 2, someone who's consistent. Now, let's dive a bit further into what these 2 terms mean when it comes to checking your credit. So, one thing that shows up on your credit report is your employment history. Are you someone that continuously changes jobs from one employer to the next? Is it 6 months here, 6 months over there? Is it continually contract work or part-time work or casual? Now, if an employer or even a lender sees that you're not someone that can hold down a job stable, are they going to really want to lend you that fund, maybe over a 5-year term or a 2-year or even a 10-year term if they see that you're someone who's continually swinging? Not so likely. If you're someone that has a gap in their employment, they can very well come back and ask you, why is there a gap? Same thing with your living arrangement. Are you someone that is continuously moving? You've had 6 different addresses within the last 5 years? That can also be a sign that they're looking for as well. Why are you moving so much? With all of these locations, this requires a change in job perhaps. Now, if you're going to be looking to purchase a home and they see that you have many different addresses, how are they so sure that you're not going to get out of your mortgage because you want to move again? So these are the things that the lenders look at. Another thing as well is the consistency. Are you someone that pays your bills on time? Do you miss payments? Do you have anything overdue? What kind of lender are you? Okay, so the same thing as we talked about with the employment history, they want to see what kind of patterns do you exhibit as a lender. Because what they're trying to do is they're trying to mitigate their risk. They're going to try to reduce the risk by lending you those funds. So if you are someone that continuously pays your bill 5 days late, you may not think it's a big deal, but when they see that your payment habits are continuously late, that is sending them into alarm mode. Do not give this person a mortgage. Do not rent this property out. If you can't manage your phone bill is reporting on your credit bureau as well. If you cannot manage your phone bill, you can't manage to remember to pay it on time, how are you going to pay a mortgage? How are you going to pay rent on time? And there are some employers as well that want to take a look at your credit report. So not so much your score, but they want to see your habits as well, because potentially you may be managing certain accounts. And if those accounts require you to be attentive and be detail oriented, they're going to base it off of how you manage yourself. So this is something you really want to keep in mind and pay close attention to. You can really improve this if you're aware, right? So when we talk about the 5 C's of credit, there are some features that you can control depending on what you're applying for. But character, that's one thing that is all you. You can't blame that on anyone else. External factors, character, which is how you manage your credit, what your credit reputation, your credit history is, that is all you. Okay, and remember, they're trying to mitigate risk. And this is what your credit report is all about. They're trying to evaluate you as an individual based on your credit history. What kind of lender will you be? Are you going to be a risky lender? Should they maybe approve you for a smaller amount? And that's the same thing. credit is going to follow you all throughout your life. So if you're going to apply for your credit card, you're going to apply for an apartment, even a cell phone plan, they may say, hey, no, we can't give you this cell phone on a 2-year term. You got to buy it outright. So please, please, please take care of your credit, especially when you're young. You don't want to wreck your credit when you're young. Okay, you want to be looking for the differences between your installment loans and your revolvings, your open lines of credit, and you want to see what is there. If you have R1s, R1s are great. So that means that you're paying everything within 30 days of the due date. Great, good for you, R1. If you get an R2, you don't want to be there. That means that you're paying things 30 to 60 days late. So you don't want to be there. R3, R4, R5, this goes all the way up to R9, I believe. So the higher you are on the scale, the more you're in trouble. So make sure if you're seeing R1s, that's great. If you see any R2s or R3s on your report that you're not sure of, that you don't know why they're there, please make sure to investigate them and try to rectify that. Another thing on your credit that it's going to show is it's going to show if you have any bankruptcies, okay, any bankruptcies on your credit report, and if you have any judgments. For some lenders, as soon as you have a judgment, it's a no-go. Now, what's a judgment? A judgment is basically a court order for you to pay any monies owed. So this can come in the form if there was something you were being sued for, or if you were taken to a small claims court for even child support payment. If you have anything that is going to be garnishing your wages, this is another big flag. Another thing, we don't want to slip our mind when we have those automatic payments coming out of our account. If we can please, please, please make sure the money is there before, because NSFs, big no-no. NSFs, not only does it cost you money every time you get an NSF, it also really reflects negatively on your credit. So be wary of those. What you can do is you can get overdraft protection. Okay, there's 2 different levels of overdraft protection that is usually offered by your bank. You can pay a flat monthly fee just to secure you, just in case anything happens. If you do go into overdraft or not, it'll still be the same fee. And there may also be a pay-as-you-go option. But it's worth it to pay whatever the $5 fee every time you get an NSF fee versus the $65 or $60 NSF fee that your creditor is going to charge you. And then on top of that, it's going to go on your credit report. So those are some things that you want to pay attention to. And like we talked about today at the top, those 2 words we're going to revolve back to. We're looking at stability and consistency. Are you a consistent person, and are you stable? Do you have a stable living situation where you're not bouncing around? Your address is changing every 6 months? Is your work stable? And even if you're not in the same position of work for 2 years, at least be in the same line of work, because creditors want to see that you're at least on the same path. If you've changed jobs, but it's in the same kind of industry, they understand that people change jobs, they move up. But if this year you're a chef, and then the next year after that you're a personal support worker, and then the next year after that you're a mechanic, and then 6 months later down the road you're going to be a customer service agent. Yes, you've been employed this whole time, but your income is fluctuating every single time you change jobs, and it's not showing that you're someone who stays in one place. The more jobs that you change, that means that at any time you can be out of work, or you may not be able to cover your bills. So that's what they're talking about stability. They want to know, are you at least in the same line of work, even if you've changed your jobs? Are you consistently someone that pays their bills on time? This is what they mean by character. In the same way that you have a friend and they want to know that you're reliable, your lenders that you're asking them for money to loan you, they want to know that you're a reliable person as well, and that you're not that much of a risk when they come to investing their money out. Because that's what they're doing. When they're lending you money, they're looking at you as an investment, because they're expecting their money back with interest. So with interest means it's for their benefit, but make sure that you take care of your credit, as it's going to follow you all the way up throughout your life, and it takes time to clear it up. If you have any blemishes, you can clean it up, but better to not make the mistake than make it and try to clean up a big mess in the future. So this is Shadeen Boino of CM Lending, licensed mortgage and lending specialist. I hope this video has been helpful for you. I'd love to hear your responses. Leave me a message down in the comment section and make sure to subscribe. You can follow me on my social media at cmlending.ca. I'd love to hear from you. Until the next video, have a great day.